Hey guys, John Polemy here, Actionable Intelligence. Today's Sunday, March 7th. Hey, I just wanted to do an addendum to the conversation we had yesterday on the weekly call. And going back to this is like a real life example of a stock that I have talked about that I gave away. It's a stock I own. It's not in the Actionable Intelligence Alert portfolio because it's even probably too risky for that. But I wanted to show you an example of what I'm talking about as far as when you should buy in and is this the right time to buy in and what I look for. I'm not saying you should do this, but I'm just telling you what I do. So um, I think when we were talking about buying the stock was back around a quarter, something like that. This is a chart of Athabasca oil sands going back a year. And you can see, you just see the big drop from last year, bottomed out. But I want to talk about this over here, some of the indicators I look at. So I like this company for one reason. This company at like oil, where it's at now, $65 a barrel and higher, it has a very large torque to the oil price. It's a very highly leveraged company and its costs are relatively high. So when the oil price gets above their fixed costs, they have the ability to generate a tremendous amount of cash flow. And that's in that neighborhood of where we're at now, 55, 60, $65 a barrel. But, you have to buy smart. So, the time to buy this was, back here when this 50-day moving average, some people call this a golden cross. This is your 200-day moving average. The red line, the blue line is the 50-day moving average. And when it crosses, it's called a golden cross. That's usually an indication of a trend change longer term. Uh, but anyways, what I want to show you is that would I buy this stock right now? No, I would not. Even though I'm bullish on the company, even though I think oil prices are going higher, this stock has had a tremendous run. Even Friday was up like, you know, 10 cents or something. It was up like 12% or something, 15%. And so what you have up here, this top line here, this is your relative strength, indicator. And when you're way above this 70, okay, you're above 70, that's usually an indication of it's overbought. It's performing extremely better than the market at large. And you can see another thing I don't like to see is when you have this big gap between the moving averages and the price. Typically, you want these this price to stay on these moving averages, right? Because what they do is what's a 50-day moving average? It's the last 50 days averaged price. It smooths out all the variations. In a 200 day is an even longer smoothing out of the 200, you know, days of the last prices averaged. And so when you get extremely above this, that's usually an indication that you're probably going to see a pullback. This thing's extremely overbought. You can see a lot of money, a lot of volume has come in here. Another thing I like to look at is the moving average indicator here. When it's way above like this, it tends to, want to correct down. Okay, this is a stock that's begging for a correction. It's done tremendously well, but I suspect that you can probably get this probably cheaper over the next several weeks or months. It's probably going to pull back. Now it may just keep going up. I don't know, but these kind of big moves like this quick are not. They're usually not sustainable. Here's an example back here in June, for an example. See, this thing just kind of shot up from 13 to basically doubled in about 2 weeks or 3 days. But then you could see relative strength was way overbought, showing it way overbought. And what happened? It pulled back, right? So you have to remember when these, let me take this out a little bit further to show you what goes on. So you have people that have been holding this stock for a long time. I'm going to take it out to 5 years and go to month. They've been holding this stock for a long time. And if they have, that's probably not the best look. Um, All right, that's better. So you have people that were holding this stock back in 2018 when it was almost $2 a share, and people have held it all the way down. So as this stock starts to move higher, you're going to start running into these levels where people are holding it, and they're going to be wanting to sell to get their money back. They may not see the recovery, they may be exhausted, whatever. But you can see when we had the COVID-related fall last year, the stock was at about 64 cents, and it just dropped to 10 cents a share because, like I said, below $50, $55, this thing is on its way to bankruptcy. It just cannot generate the costs it has are sufficiently high that it can't generate sufficient cash flow to pay its debts and keep going. But that's good if you are in an environment where we have rising prices, because once you, like I said, clear those fixed cost hurdles that the company has, most of that cash is going to go uh, into the company's coffers. So as you can see here, um, here's a perfect example of like kind of a cross on the downside. It's the same thing. This thing got way oversold. One thing I want to point out from a technical, and I don't want to get too technical because I try to go by the fundamentals. I just use the charts to kind of show where my entry point should be. But one thing I do find encouraging is the stock fell and bottomed originally. This is like a classic setup. It had a waterfall crash during the oil price crash. It bounced off that. Speculators came in, went up. It doubled in price, and then 150% gain, and then pulled back again. So you have this double bottom, right? It tested this bottom and then moved higher. You can see that here. So even on this longer term chart, you're showing it to be extremely overbought. So this thing needs to pull back. It needs to consolidate. I'm not saying it's going to drop all the way back, but I think that this thing's it's gonna need to pull back. There's gonna be some profit taking. It needs to rest, and this needs to come in, this relative strength index. And but longer term, this is looking good. This is what you want to see. So this is on a weekly chart going back 5 years. And like I said, if you just look at the last year, um, you see you get a different perspective. So stock charts, I have a subscription to it, but you can get most of these charts for free by going there. So this is how I use like charts and technical analysis, not necessarily to tell me when to buy or sell, but kind of, right now, would I put more money into this right now? No. Would I take profits? I'm not a trader, so I think the oil price is going higher over the next couple of years. I think the stock moves higher ultimately over the next year, 18 months, 2 years, with periodic pullbacks. If it pulls back, I may be inclined to put more capital in, but this is way too extended right now. So I just wanted to show you that. The other thing I wanted to show you was the couple slides from the presentation they had for their earnings call. You know, this is kind of what you want to look for: adjusted funds flow. You can see that in 2019, oil prices really weren't that high. They only had $15 million in free cash flow, or I mean, $150 million in free cash flow, 155, sorry. But last year they had, you can see right here, stream oil prices only 19 million. But they're forecasting this year, and this is based on $55 WTI at $55 and a 12.50 Western Canadian Sediment differential. So crude oil in Canada trades at a differential to WTI. So if you see what they're projecting, the management saying they're going to have approximately $125 million in free cash flow this year if the oil price is $55. That's their assumption. Average price of $55 with a $12.50 differential. Now, the thing I wanted to point out also real quick, because I don't want to take up too much of your time, is the torque. Okay, here it is, the value proposition. Unparalleled torque to oil prices longer term. Note this blurb right here, that every $5 increase in WTI, I would say above that 55, that adds $70 million in EBITDA, or roughly cash flow. So, if you think that, like I do, that oil is going to go over the longer term, over the next several years, maybe to 80, $100 a barrel, this company has tremendous torque to a higher oil price. And that's why I like this company. That's, this company, based on Eric Nuttall at 9 Point Partners. I mean, he bought a big slug of this, like 20 million shares from, I think, somebody was divested, the Norwegian sovereign wealth fund, somebody, and he just bought a big slug of this for his fund. So, um, this is the kind of companies you want to look for in a commodity bull market. When prices are rising, higher prices can really cure these companies' problems real quick. Now they have $165 million of cash. They do have some debt due in 2022, but I suspect that if the oil price cooperates, they will be able to refinance that. So, um, you see here, they have a $455 million in notes due in February of 2022, which is next year. So, I just think this is an interesting company. I wanted to show you how I use charts, and I was talking about when should you buy in if you haven't bought in. I would not be a buyer of this stock. Let me show you one that I would consider buying right now while I've got you on here, just to give you an example. Here's Suncor, which is a large oil sands operator in Canada, and you can see, let me take the chart out a little bit, a couple years to give you a better idea what we're talking about here. So you can see before the COVID oil crash, the stock was trading at $32.89, and oil prices were approximately what they are now. They were around 63, 64, $65 a barrel. You were back to that level, and the stock has not recovered that yet. So this stock has been moving higher. It's another double bottom, if you will. It bottom higher highs and higher lows is what we want to see. That's what we've got. It had a recovery and then kissed the bottom and came back off that. But you can see that before the COVID crash in last year in oil prices, the stock was a $33 stock, and it's only about $21 or $22. So that's an example of something that you probably could buy now and be okay with. It's moved recently too, though, but I'm just giving you an example. I'm just showing you what I'm trying to talk about as far as how I use charts and how I time my entries and how I put additional capital to work. So I hope this was helpful for you. I wanted to take the time to try to expand on the conversation we had yesterday, and I hope it made some sense. All right, guys, thanks for listening, and we'll talk to you next week. Thanks.